All right, we've got a new company hitting the stock market, and this one is promising to fuel India's small business engine. So today, we're going to dig into the IPO of Aye Finance and see if it's a smart investment or a risky bet.
You know how it is with every IPO, right? There's all this buzz, but also a healthy dose of, is this for real? Is Aye Finance some revolutionary lender that's about to take off? Or are there some hidden risks that investors really need to be aware of? Let's unpack the numbers and find out. Okay, so before we even glance at Aye Finance's balance sheet, we've got to understand the world they're playing in. See, there's this massive credit gap in India's economy, and it's affecting millions and millions of small businesses. I mean, think about it. The local shopkeeper, that small-scale manufacturer down the street, these are literally the backbone of our economy. But when they need money to grow, the big, traditional banks often just see them as too small or too risky. And that creates this huge, underserved market. And that's the sweet spot where companies like Aye Finance come in. They're what's known as an NBFC, a non-banking financial company. You can think of them as specialized lenders. They don't have a full-blown banking license, and that lets them be a bit more nimble and serve customers that the big banks often ignore. So, Ainge is hitting the market to raise a cool 1,500 crore rupees with this IPO. That is a serious injection of cash. And what are they going to do with it? Well, the plan is to plow it right back into their main mission, funding even more small businesses and expanding their reach.
All right, so that's the story. But does the business itself hold up? Let's check out the strengths, the key numbers that are getting investors really excited about this thing.
First up, let's talk about scale. Their assets under management, or AUM, which is basically the total value of all their loans, is sitting at over 8,600 crore. That's a serious portfolio. And what's really important here is that it's been growing like crazy. And get this, that huge loan book isn't just with a few big clients. No, it's spread out over almost 6 lakh active customers. This shows they've really built a massive network, reaching deep into the small business community all across the country. Okay, now this next number, the CRAR, might sound a bit technical, but stick with me. It's super important. It's basically a stress test. It shows how much of a cushion a lender has if things go south. A higher number is always better. And their number? Over 32%. That is a really, really solid safety net. And here's something else that's really smart. Take a look at how they manage their risk. Their loan book is spread out all over the country. No single state makes up a huge chunk of their portfolio, which means if one region has an economic hiccup, it's not going to sink the whole company. It's a clever way to build in some resilience.
Okay, but you know a great growth story is only ever half the story, right? To really get the full picture, we have to look at the other side, the risks, the potential red flags hiding under the surface.
The first thing that jumps out is loan quality. Almost 5% of their loans are non-performing, which is just a fancy way of saying people have stopped paying them back, and that's money that the company is at real risk of never seeing again.
Now, what makes that even riskier is this next number. 38% of their loans are unsecured. What does that mean? It means there's no collateral. If someone defaults, there's no property or equipment for Aye Finance to take back to get their money. It is a much higher stakes game.
And then there's this, an operational risk that's kind of hard to ignore. An employee turnover rate of 65% is, wow, that's incredibly high. Think about it. In a business that's all about relationships, having a revolving door of staff can really hurt customer trust, drive up costs, and just make things chaotic.
So we've got the good and the bad, but none of this exists in a vacuum, right? The big question is, how does Aye Finance actually stack up against the competition?
So when you put them side by side with their competitors, a pretty clear picture starts to form. You can see how finance is the smallest of the three, they're also making the least profit, and look at loan quality, their risk is the highest. But then you look at valuation and they're kind of stuck in the middle. Not the cheapest, but definitely not the priciest either.
And all of this leads us to the big question, the fundamental choice for any investor looking at this IPO. It really is a classic showdown, growth versus safety. So what's the bottom line here? The truth is, this isn't a simple buy or sell. Aye Finance is in that tricky middle ground. It's not the best in its class, but it is certainly not the worst.
So it really comes down to what kind of investor you are. On one hand, you've got this incredible growth story, right? This huge, untapped market of small businesses that are desperate for funding. But on the other hand, you have to weigh the safety concerns, that riskier loan book and all that unsecured debt compared to its rivals. So in the end, the decision isn't really about Aye Finance, it's about you. What are you looking for in your portfolio? Are you chasing that aggressive growth, and are you okay with the risk that comes with it? Or do you sleep better at night with the stability of a safer bet?
Once you answer that question for yourself, you'll know exactly what to do with this IPO.